Tesla totally crushed it in Q3. I'm going to go over some of the highlights right now, and then in this video what I want to do is delve into something that I took away that's really, really important for us to know. So let's dive right into some of the highlights of the call. In Q3, Tesla reported GAAP net income of $312 million, non-GAAP net income of $516 million, operating cash flow of $1.4 billion. And what's notable about that is that only 10% of that money came from working capital. The rest, the remaining 90% came from actual operating activities. So that's really important because a lot of bears out there were saying that, yes, okay, they can still produce cash flow, but they're going to end up stretching payables and delaying payments to suppliers to get it. Well, not so, because only 10% of that 1.4 billion actually came from working capital changes. Free cash flow of $881 million, and cash went up $731 million to about $3 billion. The Model 3 gross margin ended up clocking in at greater than 20%, and there was huge operating leverage that took place. SG&A as a percent of revenues were at 10.6% compared to 18.7% in Q2. That is tremendous. And some of the quotes that I took away from the earnings letter, it said, quote, more than half of trade-in vehicles were priced in below $35,000 when new. This leads us to believe that the total market potential for Model 3 is larger than just the premium sedan market. That, I think, is critical to know going forward. They also said labor hours per Model 3 decreased by more than 30%. This is another reason why a lot of people were shocked at the results, because we all significantly overestimated the costs that are required to build these cars in volume. And they went on to say that of the 455,000 net reservations that we reported in August of 2017, less than 20% have canceled. That's huge, because remember, they didn't report the net reservations in Q2, and a lot of the short sellers pounced on that and said, haha, they're not reporting the number anymore, it must be leading to widespread cancellations. Well, now they just reported that only 20% or less than 20% of that original nearly 500,000 Model 3 reservations have actually canceled. I think that's indicative of what's to come, because I think a big part of the remaining reservation holders are waiting for the 35,000 base Model 3. So there's still huge backlog that Tesla's going to have to work through. They continue on to say, moving on to the energy division, we expect to ramp production of Solar Roof more quickly during the first half of 2019. And they overall say that we reaffirm our prior guidance that we expect to achieve positive GAAP net income and free cash flow in Q4. Our cash position should remain at least flat in spite of our plan to pay $230 million of convertible notes in cash in Q4. More on this last point in a minute here. But the great thing about what's happening is that we can finally, after all of this, we've been waiting for years, we can finally actually start to talk about some of the traditional metrics that go into doing valuation analysis, particularly things like PE, price to cash flow, price to free cash flow. So let's just take a quick look into that, because what happened overnight is Tesla went from a pie-in-the-sky valuation, a story with a lot of hopes and dreams, to a company that's producing tangible results that we can then look at and comp it to other companies within the tech sector, as well as comp it to other companies within the automotive sector. So let's take a look at that. Now, for all of these metrics that we're about to see here, what I did was I just took the most recent quarter and assumed that that's what's going to be repeated for the next 3 quarters. And I did that equally across the board for all the companies that I'm about to show, to at least provide a standardized apples-to-apples comparison. Let's look at the PE now of Tesla. Tesla is now trading at a 45.7x PE, using the most recent earnings quarter multiplied by 4. So first off, that's actually a relatively conservative way of doing this, because we're assuming that Tesla is not going to grow its net income going forward. It's just going to repeat the same numbers in Q3. I don't think that's going to happen, but even if we did assume that was going to happen, look where Tesla ranks among these FANG stocks, FANG-like names. We see Netflix and Amazon trading at a higher multiple than Tesla, and Nvidia, Microsoft, Apple, Facebook, and Google being the cheapest of the bunch here. But you can see that overnight, Tesla went from a pie-in-the-sky valuation to something that's trading within a reasonable bound, something that's even cheaper from a price-earnings multiple perspective than Amazon and Netflix. Now, if we go to price to cash flow, the number is even better. You can see that right now, if we take price divided by cash flow from operations, Tesla is actually the cheapest of the bunch. Now, I'm not including Netflix is not included in there because they actually produce negative cash flow. But you can see that Nvidia and Amazon are actually the most expensive in the bunch, and Tesla is trading at 10.2 times cash flow. That is compelling. If we go on to price to free cash flow, the result is similar. Tesla is trading at 16 times free cash flow in Q4, or Q3, I should say, whereas Facebook is trading at 36 times free cash flow. These are very, very reasonable numbers. Moving on to price to book. Now, price to book is yet another way to measure the valuation of a company. Look at Tesla, it's right there in the middle. Amazon and Netflix, as well as Nvidia, are actually more expensive than Tesla, which is trading at 12.6 times book value. Same thing with EV to EBITDA. Now, this is slightly on the higher end, but still coming in under Amazon and Nvidia at almost 18 times enterprise value to EBITDA. Now, more on this in a minute here. This is actually my favorite valuation metric because it actually compares companies apples to apples if they have a lot of debt on the balance sheet, which Tesla does. So even when you're factoring in the amount of debt that they have on the balance sheet, relative to EBITDA, they're trading at a very reasonable range right now if we compare it to the basket of stocks within the tech sector. Now moving on to other measures. This is return on equity, which looks at the efficiency of capital that's being deployed by companies. And you can see here that Tesla's return on equity, again, taking the Q3 number multiplied by 4, it's at 27.7% return on equity, which is better than both Facebook and Google, but still a little bit on the low end compared to Amazon, Netflix, Apple, Microsoft, and Nvidia. But we can see that the party is just getting started with Tesla, and it's actually producing numbers that are within range of the comparables within the tech sector. Return on invested capital. This is particularly my favorite number because it looks at the net income divided by the total capital that both shareholders and bondholders have paid into the company. Now, Tesla is lagging that at 7.7%, but still it's coming up to a point where the numbers are starting to look compelling. So I think there's a little bit of catch up that Tesla has to do on return on invested capital, but more on this in a minute because I think something big is about to happen with this specific number. Now, before we even move on, I know short sellers and FUD, people spreading FUD are going to say, well, why are you comparing Tesla to the tech sector? It's technically an auto company. Let's comp it to auto companies. So here we go. Price to earnings relative to autos. And I also added a couple of industrials, specifically Caterpillar and Boeing, because these are also capital intensive businesses with lots of debt on the balance sheet. So I thought it'd be helpful to also include those two in here as well. Price to earnings, sure, Tesla is very expensive relative to the rest of the auto sector. It's trading at 45 times earnings versus Boeing at under 23 times earnings, and GM is trading way below that at about 5 times earnings. So again, you're right. Tesla, everyone is right. Tesla is, it's correct to say that Tesla is much more expensive than the auto sector. But then again, remember, valuations have to be looked at relative to growth. There's two things that go into the price earnings multiple or the price to cash flow multiple or any other multiple. One is the fundamental growth, and two is the amount of risk that investors are willing to take on, also known as the discount rate applied. So for a company that's growing at 50% year over year, I think a 45x multiple may be somewhat warranted. If GM or Ford were growing at 50% year over year, I think they would also be trading at quite a different multiple from where they're at right now. So I think we need to look at multiples relative to the growth rate that they're exhibiting. Price to cash flow, on the other hand, if you look at that number, look at Tesla at 10.2 times cash flow. Compared to that, it's slightly below Boeing and below Volkswagen and Caterpillar. So now if you look at it from a cash flow point of view, from operating cash flow, Tesla is starting to become, even if you consider the fact that they're growing at 50%, they're not trading at a unreasonable, price to cash flow multiple. And now if we look at price to free cash flow, Tesla is doing pretty well as well with that metric. You can see that Toyota is actually trading at a much higher multiple, but Tesla's right there at 16.2. That's right in the middle. That's slightly below Honda and below Caterpillar, but still above Boeing and GM, as well as Fiat Chrysler, which are trading at really, really low multiples. But again, as I said, we have to look at multiples relative to growth, and I think Tesla's #1 on this list. Price to book value, again, that's also pretty high relative to the rest of the sector, but more on this in a minute. EV to EBITDA, again, Tesla is actually doing much better than Ford, which is actually much higher. Now, I agree, Ford, we have to do a little bit of deeper digging. This number may be misleading because I'm conflating Ford's automotive side with Ford Motor Credit, so that's a whole separate discussion. So that may be an outlier, but still Tesla on an EV to EBITDA basis is trading about 18 times EBITDA, which is again more expensive than the auto sector, but again, got to look at the growth in the EBITDA. Return on equity, this is also really interesting. Tesla at 27.7%, that beats GM and Ford as well as Fiat Chrysler. So again, these numbers are starting to look really compelling really fast. Return on invested capital, Tesla is also pretty competitive there at 7.7%. That's below Fiat Chrysler, below Caterpillar, but above GM and Toyota as well as Volkswagen. So these are just phenomenal numbers across the board, which it's amazing because all of this used to be that you can't value Tesla, you cannot put any numbers on it, you can't look at multiples, you can't look at returns on capital, you can't do any of this stuff because all of Tesla's financials were negative. There was nothing but red ink. Now, suddenly, overnight, the numbers are looking very, very reasonable. Now, I want to point out something huge on the that I took away from the Q3 earnings call, and this was actually a reiteration of something that Elon Musk said on the Q2 call that I want to repeat here. He said, quote, and this is in response to Adam Jonas, a question from him concerning the need to raise capital. He said, yeah, that's our goal. We do not intend to raise equity or debt. At least that's our intention right now. That may change in the future. But the current operating plan is to pay off our debts, not to refinance them, but pay them off and reduce the debt load and overall leverage of the company. This, I think, is significant. And I'm going to get into this in a minute, because there's two ways a company can delever the balance sheet. One is to grow the EBITDA. So if you look at one specific metric for how a company can be measured in terms of the leverage, in my opinion, the favorite number to look at is net debt to EBITDA. Net debt is total debt minus cash, and EBITDA is the cash operating income of the business. So basically the operating income that a business produces, but adding back the depreciation, which is a non-cash expense. So what that tells us is EBITDA is a measure that bondholders look at to understand what the capability of the company's, what the ability of the company is to pay back or to service the debt ongoing. So there's two ways a company can delever the balance sheet. One is if they increase EBITDA at a rate greater than their increasing net debt. So if EBITDA goes up by a percentage greater than net debt, that is in effect deleveraging the balance sheet because the net debt to EBITDA ratio is going down. And that's exactly what we saw as of Q3. We see that from this chart right here, we see net debt going down from about 9.2 billion to about 8.8 billion. So not only did net debt go down, but EBITDA surged from negative 101 million to almost 1 billion, slightly under $1 billion of EBITDA. So that was a big jump in EBITDA and a small dip in the net debt. And that's primarily driven by the fact that they increased their cash position. So there's already deleveraging that's happening in the balance sheet. And that's why if you look at Tesla's 2025 bonds, those surged. They used to trade at a huge discount to par value. Now they're much in better shape, and the spreads relative to the bond index, plummeted. So that's a huge sign that's a huge vote of confidence that bondholders are starting to see that Tesla is deleveraging the balance sheet, which reduces the leverage risk of the company. So that's one way that we can deleverage the balance sheet. Increase EBITDA faster than you increase net debt. That's what we just saw here. But if we go on and go back to the quote that Elon Musk said, their intention is to pay off the debt that's coming up. So let's look at that. In November of 2018, which is next month, they have a $230 million convertible note that's due. And then in March of 2019, they have $920 million of convertible notes due. This is well noted, well documented, and well publicized by bearish journalists, bearish analysts, and bearish short sellers. Everyone knows that they have over $1.1 billion of debt that's coming due within 6 months from now. And let's take a look at that. So one thing that Tesla can do here is, if they do intend to pay down that debt with cash, which is what Elon Musk said on the call, let's look at what that does. From an example here, Tesla had $3 billion of cash exiting Q3 and $230 million of debt coming due in November. So let's just take a very, very simplified version of a potential Q4 cash flow statement. Now, this is not my projection. This is not what I'm estimating, but this is something that I think is important to highlight as an example of what paying down debt can actually do. So let's say, for example, they do $1 billion of operating cash flow in Q4. And then let's say they have investing cash flow of about $770 million. That's a cash outflow because that's money that's being spent for capital expenditures and other things like that. So their free cash flow, let's just say, is $230 million. Their financing cash flow, which is the financing cash outflow, which is that $230 million note that's coming due, would be $230 million. So therefore, the net change in cash is equal to the $230 million free cash flow minus the $230 million debt payment, and therefore there is a zero change from quarter to quarter in the cash balance that's presented on the balance sheet. Okay, so bear with me for a second here. Let's assume that their free cash flow is equal to the amount that they have to pay for this November debt payment coming due. So let's see, what does that do to the balance sheet? So let's look at the asset side. Let's say that assets remain unchanged, because remember, they produced free cash flow of $230 million, and then they paid a $230 million debt payment. And so therefore, cash remains steady at $3 billion and nothing else changes. Let's just hold everything else equal. Nothing else changes other than the fact that they generated cash through free cash flow, and then they paid that debt of $230 million. So what that does is, on the asset side of the balance sheet, nothing changes. It's $3 billion of cash and equivalents, and everything else remains the same, all else holding all else equal. Liabilities, however, goes down by $230 million because they just extinguished that debt that they have on the balance sheet. And so the current liabilities goes down to about $9.54 billion. And so overall liabilities drops by about $230 million. So for the balance sheet to then balance, what has to happen? The equity side has to go up by $230 million. So in effect, what that just did is, if a company pays down debt, it therefore builds book value of a company when it's paid for by internally generated free cash flow. Now, that's huge, because if they can do this without sacrificing any future growth of the company, meaning if they're going to starve, growth in production, or, laying out CapEx for Model Y or the Semi or the Roadster, if they can pay down debt without sacrificing on any of their growth plans for next year, that in effect builds book value, and that is effectively a return of capital to shareholders, which is about the same thing as if you were to pay a cash dividend or initiate a share buyback program. This is exactly the same type of thing, except this doesn't trigger a tax event for shareholders. When you receive a dividend, you have to pay a tax on it. But if a company buys back shares, or if it pays down debt, what that does is that it's a way that companies can return cash to shareholders by building book value and not actually triggering a tax event. That to me is huge, because that's the first time this type of thing has happened, where Tesla has built book value of equity without raising capital to do it, and also without sacrificing future growth. So this is huge. So let's take the big picture question. Why were analysts so wrong about Q3? We had no idea. Even the most bullish analysts, including myself, I was still expecting a small loss in Q3. But I think what we all did was we underestimated the power of operating leverage. Deepak Ahuja, the CFO, on the call, highlighted that the number of labor hours per Model 3 built dropped significantly, and so that means that productivity skyrocketed. We all underestimated the power of operating leverage. We also underestimated the Model 3 ASPs. I think there was a huge take rate for Autopilot. There was a huge take rate for the all-wheel drive. There was also a huge take rate of the performance models. So we all underestimated the average selling price of Model 3. And ultimately, we all overestimated the cost structure. So I think we all misunderstood these three things, but specifically the bearish analysts out there, as well as the short sellers, I think they fundamentally misunderstand the business strategy of Tesla from the very beginning. And I think the following chart is going to help us, clarify and highlight this very, very clearly. Let's take a look at EBITDA, right? Again, my favorite metric to look at for any company, because it's, a great measure of sort of a proxy for the company's cash flows. If we transform this into trailing 4-quarter sum totals on a quarterly basis going back to 2010, this is what the chart looks like. And look at how easy it is to actually identify why Tesla has had a lot of red ink in the past, and why it's pretty, if we take a look at this pattern here, why it's pretty easy to project what may happen in 2019. So if we look at it from the early 2010s all the way till the end of 2012, we see a constant drop in EBITDA. But what was that? That was when they were developing the Model S. And then starting in 2013 into 2014, that was a time where they were ramping production of Model S, ramping the deliveries of Model S. Then what did they do? In early or late 2014, they started spending again to develop the Model X. So then that took EBITDA back down negative. And then look what happened in late 2016 all the way to late 2017. That was the Model S and the X ramp together. And that produced a solid EBITDA figure, almost $800 million. And then look what happened after that. Predictably, they started investing in Model 3. That took them back down. Now, yes, there was a little bit of a snag where we hit several bumps on the road along the way, where we all know that there's been a lot of delays with the Model 3, so it took a little bit longer than expected. But now we see that first bar towards the positive side, where we see Model S, Model 3, and Model X ramping together. And I think what's going to happen is, we're going to see the next 3 quarters where we're in this sort of sweet spot where there's not major CapEx that's planned. There's not a whole lot of spending that's planned between now and Q1 of 2019. So what we're going to see is for the next 3 quarters, we're going to see this huge surge in EBITDA with the combined sales of Model 3, Model X, and Model S sales globally. And then what we're going to see, again, predictably, is I think there's going to be a drop in EBITDA once again when the Model Y and the semi-dev cycle starts up again. So it's really not that hard to understand. The reason why people get so confused when they look at Tesla's financials is because they see a lot of red ink, but it's because these financials are getting conflated with future spending for future growth projects. So spending always comes before revenues. When that happens, whenever spending comes first and revenues come second, that's why you see a lot of red ink. That's why you see the metrics all across the board look horrendous. That's when it looks like the company's about to go bankrupt. It looks like liquidity ratios are in the tank, but really it's because they're spending for future growth. That's what we need to understand here. So I think EBITDA, keep an eye on this chart. I'm going to post updates on this regularly every time Tesla reports earnings. But this EBITDA cycle is critical to understand what Tesla is doing with their fundamental business strategy. And lo and behold, if you look at this and compare it to a company that we all know about, Amazon, you can see exactly that Amazon in its early days is doing exactly what Tesla is doing now, where the blue bars that we see here are Amazon's EBITDA from 1998 to 2009. And the red line is exactly what we just saw in the previous slide, which is Tesla's EBITDA. And you can see that there's a pretty strong correlation. The pattern is playing out exactly the same. And I think that there is a chance, if Model 3 surpasses everyone's expectations, I think there's a chance that Tesla may never post another GAAP loss ever again. I don't know for sure yet. I think it may be. It's a distinct possibility, because we can see here that, look, Amazon had that dip when they were developing their product, their online e-commerce presence. But then look at that. They never looked back after that, after a certain point. I think we may be at that inflection point where Tesla may never show red ink ever again, barring some unforeseen issue with the macroeconomy, or if the economy hits a recession, maybe that might trigger a loss. But I don't think Tesla is going to do any more GAAP losses in the absence of any of those things. So the bearish FUD, I think, is going to still remain until Q1 2019. That's the expectation. That's my expectation, where Q3 results are going to be one and done. That's what they're going to say. As Tesla burns through the backlog and hits a wall of no demand. That's a big talking point that the short sellers are making right now. They're also saying that major debt payments are coming due. Are they going to have funding secured to pay them off? That's a big question still. The U.S. federal tax credit phase-out kicks in on January 1. Is that going to trigger a drop in demand? And the biggest plank, I think, of the short thesis is that major competition is coming from Audi, Jaguar, Mercedes, Porsche. They're all coming out with electric vehicles. Is that going to take away from the demand for Model 3, Model S, and Model X? These are the four major talking points. I don't think any of them have any merit whatsoever, because they've been saying this stuff for years and nothing has panned out. So I think the onus is on the bears to make their case now. But I think this is going to continue until Q1 of 2019. So we're giving them until April end of 2019 for any of these 4 points to materialize and hit Tesla's books. So if they fail to derail the momentum by then, I personally think Jim Chanos will exit his short position in Tesla by the end of April or early May, whenever Tesla reports Q1 numbers, and exit. I think the remaining Tesla bears will just simply be relegated to the fringes of the internet, and they're just going to be basically conspiracy theorists at that point. So that's my projection. I think Tesla absolutely crushed it on this earnings call. So I think it's just going to be incredible what's about to come in the next couple of quarters here. So we're going to stay laser focused on this. So thank you so much for listening to this and this whole accounting rant. But I hope you found the data useful. If you like it, please like and share this on your social media, on Twitter, and follow us on Daily Charge. That's our Twitter handle, Charge Daily, as well as our website, dailycharge.co. That's our website that we've started that covers Tesla from a financial news standpoint. So please follow us and subscribe and share the video and post your comments. Thanks.